Hi everyone, welcome to Bond Bytes, the daily bond market special from INR Bonds. In a special edition today, post the RBI policy review for this month, December. It's a bi-monthly policy review where the RBI Monetary Policy Committee meets to set policy rates. And in today's policy review, RBI maintained its rates at ultra lows. So the repo rate, which is a benchmark rate, and it's at 4%. Repo rate is a rate at which RBI lends money into the banking system, while the reverse repo rate, which is the rate at which RBI takes out money from the banking system, is kept at 3.25%. And the RBI is keeping money also high in the system, and this is though they are looking to calibrate this money. Having said that, RBI, while maintaining its inflation and growth forecast, also recognize the fact that global inflation is picking up pace. Many central banks across the world are starting to raise rates on inflation fears. The US Fed too is showing signs of uh, speeding up its monetary tightening, neutralizing program. They want to stop bond buying sooner than later, then also start to hike rates sooner than later. All this again on inflation fears. So clearly, RBI is sounding out that there is definitely a case for rates to rise, but they are reluctant to raise the rates now or try to uh, normalize the ultra loose monetary policy that they have set for the COVID. They still see, they do see good pickup in economic demand. They do see that demand, consumption and investment demand is picking up. They did show some kind of worries on the new COVID variant, but that's really not affecting any of their forecasts at this point of time. And they are also seeing inflation rise for the next couple of next 6 months before starting to come down again. But having said that, you must remember when inflation rises and starts to come down, it's not that inflation falls, only the pace of growth of inflation slows down. So now central banks are very happy to showcase that inflation after going to 6% has come down to 5%. Only thing, the growth in inflation has come down, not in the absolute true sense of the word. If inflation actually falls, it's actually deflation, and no central bank wants that anyways. So the market reaction very clearly is that 10-year T-Sec yields, which were expecting some kind of guidance on rate hikes by RBI, fell largely because the expectation does not happen in terms of timing. While equity markets rally largely because this policy is very positive for equity markets as interest rates are very low. That means you can take a lot of bets on risk assets like equities and higher yielding corporate bonds, etc. And the rupee again did not really react too much. It was flat, um, despite the fact that Sensex and Nifty are higher. And Nifty, clearly the rupee is showing some fears on what the global central banks, especially the Fed, are planning to do as we go along. And if given that US inflation is at 6%, which is actually even higher than India inflation. So that's the policy highlights today. And yes, I mean, do not forget to come into a Quick Invest to see the best bonds that is available for you to invest for retail investors in this kind of inflationary scenario. And obviously, you will invest with the best information so that your knowledge on the investment is very extremely high. So obviously, on terms of transparency and in terms of ease of transaction and investment, it is the best available platform. Thank you very much. The link to Quick Investors in the description here. And if you're not signed sign for our YouTube, subscribe to our YouTube channel, please do so. Thank you very much for listening.